Hi everyone, welcome back to InvestED. Now let's talk about something that spooks a lot of investors, that being market volatility. And I'm going to put a chart up on screen here. This chart really just shows the number of days each year where the S&P 500 has dropped more than 1% in a single trading session. And this data set goes all the way back to 1990. So what can we draw from this? Well, the average is 31 days per year, and that's really nearly once every 8 trading days you should expect the market to drop 1% or more. And what you'll notice is that volatility tends to spike during periods of crisis like the dot-com bubble, the global financial crisis, and of course the COVID crash in 2020. But here's what's important. These sharp short-term moves are not a sign that the market is broken, they're part of how the market functions. Volatility reflects uncertainty, and uncertainty is the price we pay for long-term returns. In fact, without volatility, there would be no equity risk premium, which is simply, the extra return investors expect to earn for taking on the risk of owning stocks over other asset classes like bonds. Now, despite how frequent volatility is, the average annual return for the S&P 500 over this time frame has been around 10% per year. So if your portfolio is tilted towards long-term growth, especially with equities, you have to expect these kinds of swings. They're not comfortable, but they are normal. So what's the takeaway? Well, instead of reacting emotionally to short-term noise, it's best to try and zoom out. Volatility isn't something to avoid, it's something to understand and manage and to use to your advantage. Thank you for listening. We'll be back soon.